Hey Nicholas, I see your question there in regards to liquidity and um, asking for a wee bit more of an explanation on it. Um, so first things first, you've really got about three types of liquidity, right? So you've got liquidations, um, you've got stop losses, and the third one is capitulation. Okay, so excuse my spelling if none of that's right, but um, now, the importance of liquidity is there's probably really two main things. Right, so one is allows for big traders to open positions of size with good spread. Okay, and the other one would be allows for markets market price to move from A to B with least buys and sells from the big trader. Okay. All right. So um, I say big trader because the majority of people who are really playing in this sort of game, they're not market makers, they're not exchanges, they're just people who are trying to open really big positions, and they need to have areas where their orders will be accepted. So if you consider what happens when someone gets liquidated or if a stop loss is hit, so what do you have? So you have a market order, okay? And for every single market order, there is going to be two parties involved, and often there will be a market maker in between who buys one, sells to the other, and that's how they make their money. It's off the spread between the two parties. So if a market order is activated, then what happens is, say you're long, you sell your position. Now, when you sell your position, someone else is buying that long, so they're buying it. So if you get liquidated, or if your stop loss gets hit, you will accept whatever price is in the order book to cover what you are um, needing to offload effectively. And so it's the same bit in reverse for a short. So like if your short gets stopped out or you get liquidated on a short, you are doing a market buy order, and anyone else who wants to sell short that's in the order book, well, they can buy that short off you based on or they can sell that short based off your buy effectively. That's how that works. So if you find that there are areas of liquidity on heat maps, um, and particularly if psychologically they look to you like a safe area to put a stop loss, um, then often that will be where a big trader is waiting patiently to open a position. Okay, so now if we look at just this as an example, liquidity, let's just say we're here to here, okay, as far as our liquidations or liquidity goes. Now heat maps are really just an estimate of open positions, open interest and volume. There are indicators like this one. There's a separate video on how to set this up, and it's relatively accurate, but at the end of the day, it is just best guess. Okay, so these kind of things are just best guess. They're not real data. But you can set these up and you can base it off various different things, and I just have it set up on open interest and volume. It's pretty accurate at that. And if, for example, a big trader wanted to take a short, they would want the price to come up into this area of liquidity so that all of these market orders on these shorts that get activated would allow them to open the position into those and therefore not create too much of a downwards pressure by trying to open their position, because they don't want the price to be going down because they're opening the position. They want the price to go down after they open their position, right? So there's a big difference, because one of those means that you're you are already kind of are suffering from a bad spread and a bad average to your open. The other one means that, once the price gets up into here and you open your position and then the price starts to push down, you're already in profits, right? So effectively entering in the short squeeze to then ride it back down. So let's see. Psychologically, that level seems like a great place to have a stop loss because it's above those highs. And sure enough, what ends up happening is the price dips down, comes back up, revisits the liquidity, and then goes. Now it doesn't come all the way up into here, and that's why you can't just trade a heat map as if it's gospel and that the price is going to go from one side of it to the other all the time, because that's just not how it works. When the price was up here and this liquidity started to form down here, if you'd just taken a short because some person on the internet had told you that, hey, these lines always get taken out, or like I saw one just today actually where someone mentioned on X, the red lines always get taken. Well, I tell you what, if you'd shorted this 176 level down here, you'd probably well and truly have become someone's liquidity by the time it got up to here at 205. So the lines don't always get taken out. There will always be some left behind. Someone did, there is someone out there who, did get the really good greedy entry, and so don't just trade these like the price is always going to return to every line. But the importance of it is really that when you see liquidity sweeps, it means someone big's come into the market and they have opened a position, and the chances are then that they're going to want to take it to somewhere where there is a decent amount of liquidity, because the same way they need that liquidity to open a position, they need it to close a position too. Okay, so that's number one. Now, the other thing is that it allows for price to move faster. Right, so sometimes what you'll find is you'll get areas, let's play this forward, you'll get areas of the third type of liquidity. So let's just see, so now our liquidity is sort of moving, we're sort of here, new liquidity. Okay, so sometimes what you get is you get these areas of capitulation, and they'll often be sideways. So this is kind of what's going on here. There's a sideways position. You don't know whether that's going to go up or down. You've got liquidity forming on both sides, so it could go either way. So once again, you can't just trade liquidity. Market structure and structure is far more important than liquidity. But you can use the two things in confluence when trading. So now let's see what happens. Okay, all right, so it's gone down. Okay, it's taking that bottom liquidity, so you'd be pretty happy you didn't just take a long up into these red bars that people say are always going to get taken, because you'd be well and truly toast down here. Now you might also still be waiting for it to come back down to this one, right? So now this is sort of like third level. There'd be a lot of people who did long up here expecting it to go up. It's gone down. Those people will now be becoming, oops, really bad drawing that one. They'll be becoming the capitulation type liquidity. So as this goes sideways, it's either going to go down or it's going to go up, right? And you don't really know which one, but it's probably not going to do either until some new liquidity has formed. Okay, so it's simply inefficient to move price around without the cascading effect of stop losses and liquidations. So let's see. Right, so now we've started to get some liquidity forming, and now you'd have a relatively new short-term range, which is kind of there to there. You're probably still not going to come down and get this lower stuff. It could be working its way to it, but not necessarily in this move, that's for sure. And now we can go either way, really. We've got, and there we go. So it's starting to push up. So, and then as you can see, new liquidity starts to come in because people are going to start taking bets that the price is going to not make it past this level because this was a previous high, and you've got people chasing the longs and they're coming in here. So the market will now be able to move through that area. Okay, so if you consider that whoever was building this position down in the bottom here, much like whoever opened a position into that liquidity, they're going to need an area of pretty big liquidity if they want to unload these positions. So that could even mean coming all the way back up into this again, or unless it goes sideways for a while and a whole bunch of something builds. So my guess is it'll just go all the way back up to that top area again. So on the short term, the price will bounce around and it'll stop out some of the people that have taken late longs, and now we've sort of got new liquidity forming here to here. And once it starts to come up into here, they'll be able to push through it and take out some of the people that were chasing. That'll start to bring more in here. So you start to see more liquidity coming in here and even more up here because people are now believing it can't go past here. Like, that's half the reason for a pullback, is actually just to make people open positions that can then be used to the advantage of the, they call it smart money. It's a bit rude, but that's sort of how it's referred to often. And now we've got liquidity forming in this new area. Okay, so that's so. Oops, what are we doing? Oh yeah, we're taking that too. Right. So I don't know whether that helps to explain liquidity a wee bit, but it's. I guess the important thing is, by itself, it means nothing really other than a bit of a timer for when markets might move, because they tend to move once liquidity is formed. Sweeps of liquidity tend to indicate when a major move in the opposite direction is going to take place, because some big player really did have to buy it or sell it all. And incidentally, when it comes to market makers and things like that, often market makers are contracted to manage liquidation events and that kind of thing for exchanges. So it's really not uncommon to see large amounts of assets moving backwards and forwards to exchanges before high risk times, because ultimately someone has to be buying the other side of it, and they're going to do that very carefully because they don't want to get caught in a position that's too big one way or the other. But all the stuff about you can look at on-chain data and tell that something's going to happen because people are moving money around, it's all just rubbish. And as far as will every single red line on a liquidation heat map get taken? No, not necessarily. Sometimes you really genuinely can get a good entry at the bottom, and you won't be getting taken. So and what I would suggest you do is use liquidity the way I would, which is I would look at things like 100x liquidity in close proximity to price. I would look at how it's developing, because obviously it gets developed so it can be used. And when the price is going down, I would be looking at the structure of how the price is going down, and I'd be checking to see, are they testing their resistance levels as they're going down? Are we forming liquidity above where we're coming from? And those are the kind of things that tell you that that liquidity is going to get utilized, or someone's going to use it to do a spike up in price like what we're seeing today. Because if they're not building resistance, but they're making the price look weak, and the liquidity is forming in a position that has some form of structural relevance, and you have to have structural relevance, because ultimately price moves to structure and liquidity is kind of more of a timer for it, and how the liquidity is being generated, it can you can take a bit of a guess as to which way it might go first, but ultimately it's still a guess. But yeah, hopefully that gives you a little bit more insight into liquidity. And yeah, let me know if you've got any other questions. Cheers. Bye.